The white line is the financial conditions index. As it goes higher, the looser the conditions are. The yellow stepladder line is the Fed funds rate. And of course, despite 100 basis points of tightening so far, financial conditions are still pretty loose. If the Fed concludes by looking at this chart that financial distortions are now developing, how does it begin to address this, Jeff? Does jawboning do anything here? What does it do?
So this is a bit of a problem for the Fed because they have a dual mandate and not a three-way mandate.
Right.
But the third part of the mandate, financial stability, becomes a very important constraint because of what we just went through in the last crisis. If you ignore it, it ends up harming your ability to achieve your stated mandates, growth and stability of prices over the long term. And so you may run into a situation where the easing in financial conditions ends up in conflict with the lack of inflation when it comes to the December rate hike. And so far, it's been this transitory story. But if you have continued easing of financial conditions and no inflation, now the Fed's going to be forced to make a choice. And if they choose to to go off of the lack of inflation and not raise in December, then you might see further easing of financial conditions, which is only going to make this a bigger issue in 2018.
Yeah, it kind of feeds on itself. Diane Swonk, is there a historical precedent for this where the Fed tightens and conditions don't get tighter?
Well, yeah, it was called going into the housing market bubble. It exactly happened. We had the conundrum back then of that Ben Bernanke, former Fed Chairman Ben Bernanke, then Governor Ben Bernanke, explained in the savings glut, and China was buying a lot of our bonds, and we saw easing of financial conditions and the shadow banking industry easing of financial conditions even as rates were going up and normalizing. I think the larger issue here is, does the Fed, and this gets into attention of the regime change at the Fed and these open seats, Randy Quarles, his confirmation hearing, that's very important to get these seats filled. He's going to have that vice chair of bank supervision seat. And I think it's very important because what we're talking about is the Fed doesn't lean against the wind like Trichet did and like the ECB did and raise rates. What the Fed has always argued is that it would use macro-prudential policies, regulation, to bring in financial conditions. That would be very hard to do, as the Fed itself is already moving to not be as hard on regulations ahead of getting new members on the Fed, where a lot of deregulation is going to be personnel-based. Randy Quarles is someone who's from the Bush Treasury, very well thought of. He's very in favor of deregulation. He's going to have that critical position. And the Fed has already said they want to ease up on banks. How do they then back off and do a pivot and try to use macroprudential policy? So I think that's going to be a conundrum for them.